refers to the revenue collection, of a business, refers to the revenue collection of a business for a particular period of time, 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 for a particular period of time. You there? And the bottom line represents the net profit or net loss. Net profit or net loss. Full stop. But there are many business expenses, also called operating expenses, in between the top line and bottom line. Full stop. So what we actually mean there is that by looking at all the expenses, we have seen the income that we have actually achieved by doing the business. We should also be able to understand what sort or what nature of expenses we are having. So in those expenses, we are just trying to relate or equate, say, if we're spending so much and we're earning so much, how viable is the business? So we are focusing much on the sustainability of the business so that as we see whether it is relevant with what we are doing or not. We go to the balance sheet. So we write the balance sheet. What's the balance sheet all about, Mr. Matthews? May you raise your voice a little bit?
No longer balance the incomes and the expenditure to see whether the company is making profits or loss. More like that.
In the balance sheet, we show assets, liabilities, as well as capital. So in the balance sheet there, we need to understand in terms of stake in the business, that is, who controls the business. It may start from exactly right from the capital structure itself. We look to say what the capital structure all about, who controls more stake. You may find that Ngani Energy, they have more shares in the company than outsiders. They do have control over the business. But if we see that there is too much of liabilities or debt as compared to equity, then the control of the company is outside. In India, we are also looking at liabilities. How much is the company owing to others? So, analysis of things like probably the liquidity analysis can be done there. All those kind of stuff. There are a lot of stuff that we need to understand as far as the balance sheet is concerned, so that we understand the financial position of the business itself. Let's write this on that. So you say a balance sheet is a company's financial statement that shows company assets and liabilities. A balance sheet is the company's financial statement that shows company's financial statement that shows company's assets, liabilities, company's assets and liabilities. It also shows what a company owns and owes. It also shows what a company owns and owns, that is, what it has and what it has as a liability what others. Comma there, the amount invested by the investors or the shareholders. That's nothing but capital. So we start with assets there. So it's you write assets according to balance sheet analysis. According to balance sheet analysis. According to balance sheet analysis, assets are written from top to bottom. From top to bottom. In terms of their liquidity. In terms of their liquidity. First off, if assets, so it should be if an asset is easy to convert in cash. If asset is easy to convert in cash within a year or less, within a year or less, within a year or less, then it will be written under current assets. Then it will be written under current assets. Then it will be written under current assets. Full stop. For example, cash, marketable securities, accounts receivables, inventories are considered as current assets. 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 And if an asset cannot be converted into cash, and if an asset cannot be converted into cash within a year, are considered as long-term assets. Are considered as long-term assets. Are considered as long-term assets. Full stop. For example, land, machinery, equipment, intellectual property are listed under long-term assets. Then we have liabilities there. You write liabilities, and under liabilities